Hi everybody. Today we have Mr. Samir Arora in our midst. He's visiting India after a very long time, and what we thought was that probably we'll get a bit deeper into his mind and try and understand, go back in history and see how he evolved and what factors really came about, which really changed the way he was viewing India or the way he's outperformed consistently. So Samir, when you came to I'll take that question later. But you are probably today the longest serving fund manager in the country, and you've seen the markets evolve over 2.5 decades. What, according to you, would be the salient points which have made India today one of the top five markets in the world?
So when I started working, I used to work for Helios Capital in New York, and they asked me whether I want to go to India because they were interested in setting up an asset management business. And I took the bet that I will be a big fish in a small pond, but that was a good enough bet in those days. In the end, obviously, the pond itself has become very big. And why has a market, which at that time was quite small and market cap and all, has become big, is not only to do with the fact that Indian growth rates are higher, not only the market returns are higher, but the GDP and everything is higher, but because so many sectors that were at that time controlled by the government and therefore not listed, and they did not exist also, the IT sector or private sector financials or many consumer companies, all these have come after my starting the business. PSUs getting listed, so the market cap has gone up and become so big for two reasons. One is new companies, new sectors getting listed into the market, and then the fact that the growth itself or compounding has been higher. In fact, this market cap will go up even more because now we have hundreds of these unlisted companies which don't feature in our market cap. So maybe 10 years later, we would become whatever, third or fourth largest. Not necessarily to do with returns, but just the fact that more and more companies are getting listed. But actually, the returns themselves have not been bad. So the Indian market, at least in the last 20 odd years, has beaten the returns in dollar terms than the returns of Warren Buffett or Berkshire Hathaway. And this is in dollar terms. So market itself has compounded at a decent rate, and the size has gone up because of new listings and new sectors coming into the market.
I remember starting to service you in '94 itself, and I also remember that you told me that you were an analyst earlier before you came to India. You straight away started wearing a fund manager's hat, and you were a total greenhorn when you came to India.
Zero experience in it.
Right. But still you managed to beat all the other competitors or all of the other funds which were there very handsomely. How did you manage that, Samir? How did you evolve?
So, when I came here, I had been an analyst for 2 years, and that also for Japan and Australia and New Zealand. And suddenly I was the CIO of Alliance India. But the good thing is that in India, everything takes time. So it took about 1.5 years to actually set up an AMC, to get approval and their office and hiring. So for that 1.5 years, I was a full-time learner or a student because I had nothing in terms of investing work to do other than to learn. So I met all the companies, whoever I could meet, and even journalists and analysts like you and whoever else I could meet. But then in the next 1 or 2 years, first of all, there was some training as an analyst at Alliance and some philosophy that they have of bottom up and all that. But they allowed me full freedom because there was no day-to-day boss that I had. Although technically I had a boss in New York, but I could choose my stocks or my philosophy, and then I was helped by the emergence of new sectors, IT and others, which maybe the Indian fund managers at that time did not accept it as openly as I did. So whatever be the thing, yeah, we did well. And by the end of 2003, actually Helios Capital became India's private sector equity mutual fund company. And starting from zero, I became India's biggest fund manager in terms of equity funds, non-PSU, among all the new guys. So it was luck plus a bit of the fact that I like finance and I like investing and I like learning, and it all worked.
So you mentioned philosophy. In fact, one of the most interesting parts or the core of your philosophy is first to reject names rather than selecting them on good factors, right? Rejecting them on bad rather than selecting on good. Where did that philosophy evolve?
sad. I don't know when it evolved, but more recently I read Nicholas Taleb in one of his books saying that via negativa works better than via positiva. That means choosing by rejecting is better than choosing by whatever, accepting. And actually in real life, you always start with rejection. So for example, if you have to marry a girl and you're going for the first date, you say, not interested, story over, no further work to be done. So the rejecting is first. Then if you like the girl a little bit, then you will do more research. You will say, now I want to meet her a second time or a third time or a blah, blah, blah. And then you'll say, I want to meet the family. So in the end, the positive selection is a much longer process. Rejecting is one meeting, one out. Warren Buffett says, I don't like tech. He doesn't say, I first met the tech company, then I met the directors, then I analyzed the annual reports. He says, not for me. So rejecting comes first. Then what he doesn't reject, he starts researching. So the thing is, in the end, there are only two kinds of stocks, good stocks and bad stocks. Between the good, you can try, but my thinking has become that there is value in differentiating between good and bad, and not so much value, and also you cannot easily do it between good and good. So if you reject the bad, half the job is done. Then you can try between the ones you couldn't reject on whatever factors we have made, some 8 factors. Then you can try and say A or B. Half the time you may get it wrong also, because there's nothing bad, nothing obvious on which you will differentiate between them, but then you try and you will do something, maybe marginal difference in valuation or management or whatever. But rejecting is 50% of the job, and you do that every day in your life. When you choose an office, you say, मुझे उधर नहीं जाना है. Half the job was that. Now, अब आपको BKC में whether you find this building or that building is okay, and nobody cares beyond a point. What we are saying is that a good company cannot be just a stock that did well, because that is how we define, because that is known at the end of the term. So for example, if we say, look at some company A, it has gone up 400 times in 20 years. So therefore this proves that if you buy good companies and good managements and hold them for 20 years, you can make whatever, hundreds of times. The thing is, you did not know 20 years ago that this company will do it, because at that time there might have been 5 or 10 very similar companies. For example, look at private sector banks. Today we say HDFC Bank has done well and Kotak Bank has done well, great managements. But in 96 or 98, first of all, Kotak was not even a bank. But you had many other banks, GTB Bank, Times Bank, Centurion Bank, Bank of Punjab. At that time, I don't remember, but you could have said 1 or 2 have good managements also. Recent example is Yes Bank. When it listed, you would have said foreign banker, experience in multinational, blah, blah, blah. So only later you say, oh, sorry, not so good. So therefore, to say in hindsight that good managements have made return is obvious, because they have made return, so they must be good in some sense. But how would you have identified them in advance is the whole trick.
So by rejecting the bad, you are left with only good.
By giving benefit of doubt to neutral factors. For example, you may not be able to say the management is good, but you should be able to say it is not bad. So at least there is nothing that we have heard, there is no stories that we have heard, nothing on Google, nothing in terms of the guys who did the IPO, all the stories you can hear. And then you are being a bit strict on rejecting the bad, but the guys you are not rejecting does not mean they are good. It means they are not bad on this factor, but they better be good on other factors. They means the company. It could be on theme, it could be an opportunity, it could be otherwise cheap. So it is good on many factors. On 1 or 2 factors, it is not bad. So when I bought HDFC Bank, I am not saying that I knew at that time that he is good, Aditya Puri, but there was nothing bad. They have come from Citibank, they have taken a bet, they have skin in the game. But the good things are the stock has, the theme has, advantage of competition with state-owned banks. Banking otherwise a new sector. They can do things which state-owned banks can't do. They can hire better. They can have better offices, better customer service. But literally, can you say on day one that the management is very good? We didn't know. So it's not that we bought only HDFC Bank. We bought 1 or 2 of the other banks also. But the bank that does badly, you lose 20%. And on the thing that you did well, you made hundreds of times. So that is why works out in the end.
Buy and forget. Are you into that camp?
No, buy and forget is actually a wrong thesis, because I think even Warren Buffett does not do it. So for example, he says put all your eggs in one basket and watch the basket closely. So why are you watching the basket closely? That means you are not forgetting. Forgetting you do means you bought and then you say, okay, 3-4 years later we'll meet somewhere and figure out how you are doing. So long-term investing does not mean buy and forget. I have owned HDFC Bank for 25 years, even in the funds, and even personally I've owned. So there you are holding it because the bank is continuing to do well. So we have held some private banks for 10 years, some of these tech companies for 5-7 years in the new round. And you are holding them because when you evaluate them, they're doing well. So you say, very good, keep it up and let us relax. But if you are doing badly, and I say I'm a long-term investor, will I say, no, don't worry, I'm a long-term investor, doesn't matter? No. So all these guys who say that we are long-term investors, at least after the purchase, first time you bought a stock and you say a long-term, at least for 2 years or 1.5 years, don't question that fellow, because now you just bought it with all the research that you could. So why next day you are going to their analyst call and their results call? Therefore, nobody is a buy and forget. It is a story, because the stocks that have done well, the view has been made that it was forgotten. It was not forgotten. They were doing well, so you continue to hold it.
So for you, long term is a series of short term.
Correct. So long term is a series of 1 to 3 year terms. How we came up with this number is, first of all, in the olden days, there was this tax angle. If you hold it beyond 1 year, it is okay. So at least hold it for a year. But secondly, if you realistically evaluate managements, the management fellow also doesn't know beyond 2-3 years. Secondly, some government policy, interest rate, valuation, market preference of stocks, and even your ability to see the future, it cannot be beyond 1-3 years. But that does not mean that in the second you'll automatically sell the stock, because you are continuously evaluating, and if it looks broadly okay, you will hold it, which is how we've held some of the stocks for very long. But if you go in also with a 1 to 3 year view, you are not making these assumptions. Even though I paid a very high PE, I'm going to hold it for 10 years. So the earnings growth will be 20. So I will lose X% on PE. For 2-3 years, you can't make those assumptions. So automatically, you'll be more careful buying the stock, because you can't in 3 years say, now I will exit at either very high or whatever. You will say at least at the same. And therefore, you will be a little bit more restrained in what you are buying. Because the 20-year story, first of all, you relax, your analyst relaxes, and you are trying to make the investor relax. If the stock is doing badly for 5 years, you say, no, don't you remember, we hold it for 20 years, so there is 15 years left. I don't believe in all these stories. 1 to 3 year, and please hold forever if that 1 to 3 year keeps working.
So one of the cores of the theme, basically the rejection factors, is you go on themes, right? Which you always told us that the theme gives you a sufficiently long runway for not only the stock to grow, but also re-rate as and when the consistency of earnings kicks in. One of the themes which is very unique, which is very different from what one sees in the market, is compete with the government. How did you come upon this theme?
Actually, now it may not be that unique, but in the 90s it was unique. Actually, my story came in the book also on HDFC Bank, that this was the theme that I came up with randomly, but that theme worked very well. I did it for Z. Again, actually, if you say where do I attribute it, I would attribute it to Subhash Chandra. So in some 90s, sometime, he made a presentation saying that this is the time for Doordarshan 1 and DD1 and DD2, what is the programming time for movies, for news, for agriculture, for politics or something, and music, Chitrahar. So he said 24 hours into 7, I think he did, into 2 channels. So many hours of this, so many hours of this, so many hours of this is their programming. And then he said for us, it is basically half is entertainment and half is movies or songs. Everything is entertainment. It's movies, songs and serial. But nobody will watch that other channel. So we never, we owned 5% of the company. And market cap was 50 million. And we said nobody's going to watch Doordarshan after that. And we don't care what is the advertising growth, what is this, because whatever is a market will come this side. So if I really think maybe that was the one, well, that's the one I remember. Then it became very easy. We did it with every stock. HDFC Bank and Kotak Bank much later against PSUs, Bharti against BSNL, and Z to ho gaya tha. And then we even tried insurance. That time you were also there. We didn't have any listed companies, so we bought Indian Rayon because it had the highest percentage of insurance exposure. But that didn't work much because it was not directly the company that we were owning. But broadly, that has worked 95% of the time.
Diversified versus concentrated. I believe you've got very strong views here. So can you just share that with us?
So diversified versus concentrated is very easy. That the concentrated is a lottery. And I don't want to play lottery because very simple. Let's say there are 100 guys in the market who are concentrated and everybody else is diversified. Because let's say the concentrated guys, because what Buffett said, what did he say? That the diversified guys don't know what they are doing or something, and the concentrated guys really have a view on that stock. So something like that. So let's say there are 100 guys only out of millions of people who are concentrated, and therefore they are all owning 10 stocks each, in which they are very concentrated. So they exactly know, and they are supposed to do well because they know. So totally that means there are some 1,000 stocks on which somebody is concentrated. Let us say some stocks are common. So two people concentrated might have the same stock, or even 5 might have. So let us say there are only 250 stocks in these 100 investors in which they are concentrated, so they know what they are doing. So if they know, if I buy some of those stocks, I also can say that they know, so it's okay. The point is all 100 cannot do well. Because if all 100 do well with different stocks, that means the whole market is doing well. If the whole market is doing well, I will also do well. But realistically, what will happen is that sometimes that one fellow will do well, sometimes the other fellow will do well. And one fellow will do very badly because all cannot do well. And the guy who does well will come on TV and say, see my returns. And the fellow who does badly will be working in some other job and you will never hear from him. So you will only hear from the winners. The reality is that a very large number of companies do well. According to us, 30 to 40% of the market does very well, means they do much better than the index. Because the index is an average return, let's say, of 500 companies. So almost by definition, some 200, 250 companies will do better than the index and some 250 will do worse than the index because the index is an average of the same companies. So if 200 companies are doing better, some 150 are doing really better. Of course, you don't know in advance which one they will be, but some 150 out of 500 companies are doing well.
But you're hoping that your rejection will...
So our rejection will throw out many of those.
Right.
So you will get a higher percentage of your companies on the right side of the screening. And then if you're buying 30, 35 companies, without your knowing, some of them will do very well because you've screened them to at least not be bad. But nobody will know ahead of time whose turn it is next. We bought Bajaj Finance in 2011. It went up some 70 times for us. Do you think that the management knew? Do you think Sanjeev Bajaj knew? Do you think Rajiv Jain knew that they are going to be the new heroes? When I came to India, I thought I have to beat the market by 1 to 2% and I will be a hero. Did I know that I'll beat the market by 32% per annum for 8-10 years? Nobody knows. These things happen. So you have to play the odds game, improve the odds in your favor in terms of saying I have some advantage over the market. But then like a casino, you have to play the game repeatedly. Otherwise, suppose I'm shorting some stock and there's the takeover. If I have one stock, and I say, I know everything is bad, something else can happen. It might win they might win a lottery somewhere. It has to be played with a little bit more number of stocks. And then broadly, you cannot be beaten. If you have done the work exactly the same as what a concentrated guy will do, except that you have a little bit of humility or whatever, ki bhai, we don't know everything, so let's not overdo. So if you see our categories, we say high confidence in reasonable return, reasonable confidence in high return. We don't say high confidence in high return. That's why we are not concentrated.
How does that give you that flexibility to develop a diversified portfolio in the sense the second bucket of reasonable confidence and high returns. Are you looking at future winners there, which could be a multi-baggers, because the top part of the portfolio is going to be something like a concentrated portfolio, right?
So what we have done is high confidence in reasonable return means that the confidence is high, but when the confidence is high, returns will not be high. And why did the confidence become high? Because those companies have been doing well for many years and were still fairly valued, let's say. In today's context, there could be some private sector banks, some software companies, and maybe one or two consumer type companies where you say they are not very far out of line of their valuation and growth or whatever. But बेचारों ने काम अच्छा किया, so the history is good. Therefore, we have high confidence. But you are not the only one who knows they are good companies. But you may say, I've chosen them from a universe of 60, 70 companies. I have chosen 10, 15. So I'll buy 4%, 5% per name. So 50, 60% of the portfolio is a little bit of a compounder type. But then there are companies which meet all your criteria, that they are not bad on those 8 factors that we have, that they are good on 5, 6 of them. But still there is a twist in the story. They are new. Their management might be new. The stock might be down 60%. That's why you're interested. Like we bought Indian Hotels just after COVID. The hotel is closed. So how can you say I'm very confident? But everything else is good. And you can say, okay, 3 years later, COVID will go away. 4 years later, hotels will come back. 5 years later, I'll get the price of yesterday. Yesterday means just before COVID. So still it's not bad. You'll double your money. So how much will you buy of those kind of stocks? We have stocks where we like everything. The stock is down 70%. Like we had IndusInd Bank. Fortunately, we didn't have it when it fell. But after it's fallen, what will you do? Will you say, I know everything? You say, no, it's worth a 2%. So we buy 2% in these names, which on everything looks good, but we are too humble to buy 5%. And mostly we have got nearly every multi-bagger, other than maybe 1 or 2 specialty chemical type guys. We have got nearly every multi-bagger of this market by starting with 2%, because not only that we didn't know, that fellow didn't know, his dad didn't know, nobody knew that will be suddenly such a big hit. But when it became a little bit of in the momentum, you're most welcome to add another 1% to it, 0.5% to it, make it 3-4% of the portfolio instead of 2%. It automatically will become if it does well. But we are not going in thinking this is a 100-bagger. I've had many 100-baggers without knowing even one of them will be a 10-bagger also.
So Samir, you've always said that even the investor who thinks that he's investing in a concentrated portfolio is not really believing in that. Why do you say that always?
No, I say that he's not really concentrated, because you might invest in 1 or 2 concentrated funds, but very rarely have you seen even endowments in the US and all these guys who say we like concentrated portfolios, giving all their money to say one US fund manager. In the end, they will invest in 5 or 6 concentrated fund managers. So in the end, they are not concentrated. I think the concentrated portfolio, and some individuals say they are concentrated, but then they will say we have invested only 20% of our money in the market. So if you do it like that, yeah, you could say I'm concentrated. In reality, nobody is concentrated. And even Warren Buffett is not concentrated, because he has first given some money to those 2 young fellows, Ted and Todd. Then he has some 100 unlisted companies. He has bonds, he has float, and he has cash. Then he can keep saying, in my equity part, I am concentrated. But the reality is, in the publicly listed part, he is concentrated. But overall, he is not concentrated. And nobody is generally concentrated. Actually, the concentrated strategy is, as I said, that the winner takes the stories, but there are nearly equal or more number of losers. It is just maths or just normal this thing, that if there are 50 stocks in the market, maybe leaving out 10 stocks, somebody would be concentrated in all the other 40 stocks. Somebody will always have one of the stocks that you own as his concentrated bet. Whereas you are trying to cover yourself for a situation where if that stock completely fails, you can still do well because of having more. So diversified does not mean that you've randomly bought the stocks. Diversified means that we know that some 1/3 of the market does very well. The last stock of that 1/3, let's say 150th stock out of 500, is so good in terms of pure performance. You can see it statistically, we show it all the time. So that means there's some 150 stocks you can buy. You don't know in advance which are these 150, but if you buy 30-35 stocks, there's a higher probability that some 15-20 of them will land up in that 150, not because it randomly you bought them and put them in the portfolio, because you did all the research, except that you didn't buy only 10 stocks, you bought 30 stocks. And the proof of our pudding is our 25-year track record.
You've also been associated with fair number of multi-baggers. Can you share some examples with us and how you hit upon those?
So I told you, basically, we played these 2-3 themes very well. One was competing with the state-owned companies and taking value, market share and transfer of value. So look at how India has done its privatization. India has not privatized the companies, they have privatized the sectors. So for example, in banking, we didn't really sell off any state-owned bank. Instead, we allowed private sector banks to come in. And all this started with the mutual fund, where I was seeing the government did not sell off UTI, but they allowed all Alliance and Templeton and all these guys to come in. So whatever was the size of that pie, and that pie was growing, say, 10% per annum, the private guys were winning some 2% extra market share. So let us say after some years, the market share of the state-owned guys was 90 and the mutual fund was 10. Because it was 10 and because there were 20 of them and they were running around and doing some better job, the 10 became 12. So that's a 20% growth for these guys, and the state became 88. And then the whole pie grew 10%. So that was the formula. So that formula we have fully exploited. I made 100 times in Z in 2 years in our fund in Alliance, and we made 1,000 times plus in HDFC Bank. We made some 50 times in so many of these IT companies, and the whole NAV is up a few hundred times of the fund. So it had needed all these stocks. But basically, in new days, we had iShares, Page, Bajaj Finance, all of them. But don't worry about the 2% part. People I see on Twitter saying, oh, if you know this stock is going up 50 times, or they can't even imagine 50 times. But anyway, let's say they say it's going up 50 times. How will 2% change your life? Well, first thing is you don't know it's going up 50 times. It will go up out of your group. Second is the 2, if it has to go up 50 times, first it has to double. So your 2 will become 4. Once it doubles, you may also get more confidence. You can buy another 1. And then from there, you can enjoy the 25 times. You don't have to straight away think. So we want the stock to be a little bit in momentum after we bought it, for us to feel even more bullish on the stock. Because when you are buying it, kuch na kuch twist hai story mein. Otherwise, it will be in the first group, which is high confidence, which means reasonable return. So in the mix, you get that steadiness of the first group and the alpha of the second group.
We also have one slide on themes to avoid, but not invariably, but sometimes, seldomly, we do pick up stocks within those themes to avoid.
Which we say avoid.
How do we justify?
So the thing is that initially we had these rigid things that we don't like 3 or 4 themes. One is we don't like commodities. We don't like state-owned companies. We don't like billion consumer stories, and we don't like companies which are basically essentially foreign companies but just happen to be listed here, or the Indian company has bought some Australian company or an Egyptian company at 5 times PE, और हमारे market में कहता है कि हम तो 40 PE पे काम करते हैं because we are a consumer company. So we say buy Indian India play, not owned by Indians. But then over the years, we realized that we can't be so strict on this, because sometimes the label of a theme gets overridden because that company is something different than what we think. So for example, we say we don't buy PSUs. So one reason why we don't buy PSUs is because we think private sector will compete. But what about, say, a company like Bharat Electronics, where there is no private guy competing? So why should I, if the government says I want to spend, there is no private guy able to, or in today's situation, getting that. So I can't say I don't buy PSUs. Then sometimes the PSU management is actually quite good, or they are pretty good. For example, State Bank. Now it was, we bought it in 2020, it was trading at some 0.3 times book. I can't keep saying I don't buy PSUs. What we mean is we normally don't buy PSUs. We normally don't buy commodities. We normally don't buy this. But if once in a while, some companies beating its label, so it means there has to be a higher hurdle for buying something which otherwise you don't like. And again, that also we are buying 4 or 5 stocks, if at all, out of the 35, and total maybe 10-15%, 2-3%. So that much is needed, because just because I said it once in a slide that I don't like PSUs doesn't mean that the whole world will operate on my rules.
When do you sell, Samir? Because it's always very hard to sell in a rising stock. So when do we finally?
We have sold many stocks, as you know. iShare, Page, so many Asian Paints, even some of the other ones. So the DMart. So the thing is, we have made this as rule that first group, which is stocks that are well known, which we call high confidence and reasonable return, because either when we bought it or whenever the period started, it was well-known name, it was trading quite properly. You are hoping to get the earnings growth as price appreciation. So if the earnings grows 20% and your stock price grows 18%, also okay, it should not grow 10%, which means you are losing on the valuation. So that is what we are hoping to do. But what if a well-known stock is growing at 15%, but its stock price is appreciating year after year at 30%? We will initially enjoy it because we have it for whatever reason. But then over time, we know this is not sustainable. So we will trim and one day completely sell. In the end, in 90% of the time, they will correct. 5 times they will not correct. It's not that when I sold that stock or sell that stock, I am putting that money in a bank. So I'll buy some other stock which will look to me at that time. So plus minus a few percent, it will also go up of whatever the alternative is. But broadly, these things cannot go to the moon. In the second group, where we are sort of a little early, where we are buying these 2% name, there we are hoping to make higher than earnings. Because we are saying we have bought it either when the stock is falling or when the hotel is closed or the CEO has changed or management is very new. So some bigger, or it's a slightly smaller company. So the bigger fund managers or the stodgier guys will take some time. We are faster. We are earlier. There you are supposed to make a little bit more than the earnings because they are being discovered. And we are thinking that we are relatively early in their discovery or in their rediscovery. Every stock doesn't have to be new. For example, we bought ICICI Bank in 18. Right. It was sort of a rediscovery. Everybody already for 10, 20, 30, 50 years, whatever ICICI has been there. But we bought it in 18. But we didn't buy 5-6% like we have now. We buy 2.5% or something.
And the re-rating happened.
Then you also get confidence and you can take it up. Nobody's stopping.
Right. During your alliance days, you were the fund manager for India, CIO for India, and then you got a promotion and you moved to Singapore in 98 and you became the emerging Asia head for Alliance Capital based out of Singapore. How did that change your view on India, or did it add to your learning and did it give you some new flavors?
Yeah. Managing money from Singapore for India is very easy. We call Singapore the nicest Indian city. It's only 5 hours away. One endowment asked me, how can you be sitting in Singapore and managing money in India? I said, do you tell your New York guys, fund managers, to not buy companies based in California? It's the same 5-6 hour flying time. The second thing is the time difference with Singapore and India is brilliant. So here when I am in hotel in Mumbai, suddenly when you wake up 9 o'clock, CNBC and ET Now and all are blasting away to full glory. It's so early. Wahan pe you have 2.5 hours where peacefully you can understand in the world. You can see the morning stuff, overnight stuff. The market opens at 11:30, 11:45. And thirdly, there is a big ecosystem there of fund managers. Most of the Indian analysts come there. All the companies start there. Roadshows from Singapore. Actually, before the mutual fund industry picked up in India, which is 2017, there was more money managed in Singapore for India than by the Indian mutual fund industry. But still, it's quite big. And therefore, that, plus, because now we have Helios manages a global fund, all that stuff also you can get. Plus, there are more for foreign fund. there are more flow of even investors through Singapore than it would be if somebody was based in Mumbai. So I like this idea that you are there and here without being overly here or overly there.
So when you started off Helios in 2005, till then you were a dyed-in-the-wool, long-only fund
Mr.
manager. Yeah, the bull, the big bull.
Big bull to hai, but yeah.
Okay, the bull. Yeah, but then you decided to start a long-short hedge fund. What?
So
made
first
you-
thing, you also joined with me. So we both agreed that we can short. And over these years, actually our shorting has worked quite all right. Because first thing is, in a big picture sense, we say there are three kinds of stocks. One is the stocks we own. One is the stocks that are similar to what we own, so we won't short them. For example, if you are long TCS, there's no need to short Infosys and do this micro, or if you own, which I will not, but if you own BPCL, there's no need to short HPCL, just a waste of time. So there are stocks we own, stocks that are similar to what we own, and the rest is free universe for finding some shorts. And in the shorts, we have over time realized that we are not trying to find fraud. We are not trying to say, oh, this company will go to zero. That company should underperform the index, while my long should outperform the index, and therefore this thing will become bigger. Because the extra shorting that I am doing against the extra long, I should add some difference. But we are not trying to do this intra-sector. That is too tight and it's too small a difference. Ki long Infosys, short TCS, you'll make 2%. हमें 10-20% चाहिए. But the good thing about India is that at various times, various sectors have blown up in front of us, and we have had the pleasure of shorting infra stocks and some group stocks, and telecom stock, and so many stocks. वो हर वक्त कोई ना कोई होता है. Nowadays we have made how much? 15-20% on these highly valued, high quality stocks. They've all freely given you 15%, 18% return on basically the futures. So it is all good.
We've always believed that India is a perfect market for a long-short product. Why? Can you just elaborate? Why?
No. So the thing is that normally in the US, the long short product is like a different than a long only product. That's why you see all these hedge funds, they underperform the market. But they say, oh, our risk return is different because we are only 60% net, say, or 50 or 40. Therefore, don't compare us to index, because remember in 2008 when the market fell 20% or 30%, we fell only 10%. Now, actually, they should say that we have outperformed the market, because remember that in 2008 we fell only 10% less or 20% less. So therefore, that gave us so much compounding that over time they did well. But they give ulta story. We have always made this goal that our long short fund should outperform everybody's, or at least the long only benchmark. And if you beat the benchmark long only index, then you will beat 80% of the fund, because the poor guys don't beat this thing. So that has worked because of you and me and others in our company. But broadly, the idea is that when the market falls, you will not make money. You will fall less. Right. When the market goes up, you will go up, sometimes not equal to the market, but you have to control these underperformance, whatever you call it, so that over a 4-5 year, you have outperformed the market, not outperformed the hedge fund guys or the 60% of the market. And that we have been able to do in Helios for 17 years, nearly every 3-4-5 year period.
Thank you, Samir, for this insightful interview. In fact, if any of you have any other further questions, you are always free to contact us. You can go onto our website, which is helioscapital.in, and ask us questions there, or you can directly contact Samir on his Twitter account as such. Thank you.
Okay, thank you very much.
Thank you.